In the quarter ended June 30th, AMC's theaters produced $238 million of operating income, up 157% from a year earlier. The business worked, and the company still reported a net loss. Here is where every dollar of it went. Start with what went right, because it is genuinely good. Revenue rose 14.2% to $1.6 billion from $1.4 billion a year ago. Costs and expenses were $1.36 billion. That lifted the operating margin from 6.6% to 14.9%. Now the part below the line. Non-operating expense for the quarter was $246.1 million, against operating income of $238.1 million. The capital structure cost more than the entire business earned in its strongest quarter of the year. Here is the breakdown. Interest on debt, $115.9 million. A $33 million loss extinguishing the exchangeable notes due 2030. A $30.1 million loss extinguishing the Odeon notes due 2027. And other non-operating items of $109.6 million. Pre-tax, the quarter was a loss of $8 million, and after-tax, a net loss of $11.4 million. Two of those items deserve separating. $63 million was the cost of extinguishing debt in refinancing transactions, not the cost of running theaters. Those are one-time in the narrow sense. But AMC has refinanced repeatedly, and every round has carried a bill like this one. And that is the comparison that matters. Interest runs near $460 million a year. Operating income was $238 million in the best quarter of the year. The first quarter, by contrast, brought in $1,045 million of revenue and a net loss of $117 million. Averaged across a full year, the operating engine and the interest bill are roughly the same size. The balance sheet says the rest. Cash is $778.4 million, which is real liquidity. Against it sits $3.9 billion of long-term debt and finance leases, plus another $3.8 billion of operating lease obligations for the theaters themselves, which produces the number most people miss. Total liabilities are $9.5 billion against $8 billion of assets. Shareholders' equity is negative $1.45 billion. The company owes about $1.5 billion more than everything it owns is carried at. One more detail worth holding side by side. Depreciation and amortization was $76.1 million for the quarter. Operating lease expense was $223.8 million. The rent on the theaters is roughly 3 times the depreciation on everything AMC owns. This is a company that rents its productive assets and owns its debt. So how should the equity be valued? Not on a multiple. At $2.27 a share, add net debt of roughly $3.1 billion, and the enterprise is capitalized near $5.5 billion, before counting the operating leases. The equity is really an option on whether operating income can outgrow a fixed interest and lease burden before the debt has to be refinanced again. Worth noting, the share count keeps moving, and in March, the company issued 15.4 million shares, just as consent fees to note holders. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description.